Hey everyone, this is Damien and welcome to the I.U.L lab. I always get asked, what would happen to life insurance companies if the US financial system started to collapse? Which institutions would fall first and which would survive the longest? More importantly, where would your money be safest? Let's talk about that. So let's be real. If things ever got so bad that financial institutions started going under, it wouldn't happen all at once. There's a hierarchy to how fragile each sector is and which ones are most exposed. At the top of the collapse list, risk-based institutions. That means banks, hedge funds, and stock market brokerages. They're the most exposed to market volatility, leverage, liquidity runs, and investor panic. When confidence in the economy breaks down, these institutions feel it first. Think 2008. The next layer down, you have credit unions, regional banks, and pension funds. These hold longer-term assets and obligations, but many are underfunded or highly dependent on interest rates staying predictable. If the economy tanks hard, these groups start to shake too, especially pensions that promise way more than they can deliver. When panic spreads, the federal government usually steps in. Stimulus, bailouts, emergency lending, and FDIC guarantees. But even the government has limits. And if confidence in it erodes, then we're in uncharted territory. So what about life insurance companies? Here's where it gets interesting. Life insurance companies are built differently. They don't rely on speculative trading. They don't run on emotion, hype, or fear. They're in the business of guarantees, long-term contracts, and risk management. They're some of the most heavily regulated financial entities in the country. They're required to keep massive reserves known as legal reserve ratios. They undergo stress testing, actuarial audits, and are supervised at both the state and federal levels. Many have been around over 100 years and have weathered every recession, depression, and financial scare you can name. Now I know what you might be thinking, but aren't insurance companies leaving states and canceling coverage? Yes, but that's mostly home and auto insurance companies. And here's the difference. Home and auto insurers are tied to short-term catastrophic risk, like fires, floods, and natural disasters. When risk goes up and claims spike, they can pull out of states to protect themselves. But life insurance is different. It's based on long-term actuarial science. Life insurers don't just cancel policies or exit states overnight. They're built for stability over decades, not just year-to-year risks. So while your homeowner's insurance might change providers, your life insurance, if structured properly, is far more secure and consistent. So what would it take to collapse them? Well, for a life insurance company, especially a big one, to collapse, you need a scenario where millions of policy holders die at once, like a massive global catastrophe. Markets are down and all their bonds default and all regulators fail and the reinsurers can't step in. The US federal and state governments also collapse. At that point, you're no longer worried about your retirement account. You're worried about your next meal. So here's the takeaway. If the life insurance industry ever goes under, it's not just a financial crisis, it's a total economic collapse of civilization as we know it. It's scary to think about, but it's true. And if that ever happens, guess what? 401ks, crypto, stocks, real estate, they're all toast too. That's why people who understand risk and long-term planning look to the most stable, guaranteed institutions to build and protect their wealth, not the riskiest ones. Life insurance companies aren't just about death benefit. They're about preserving wealth in a world full of uncertainty. So if you want to learn how, let me show you how people are using life insurance in ways most don't even realize. So follow me for more and comment SAFE, S-A-F-E, if you want some more information. Thank you and take care.